Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about China Eastern Airlines Corporation Limited annual report. China Eastern Airlines Corporation Limited offers a wide range of services to cater to its customers' diverse needs. The airline provides passenger transportation through its extensive network of domestic and international routes. In addition to air travel, the company also offers cargo services, transporting goods across various destinations. The airline services extend beyond transportation, with offerings such as mail delivery, ground handling, tour operations, and air catering. It also provides miscellaneous services, including flight training, maintenance, and consulting. Furthermore, China Eastern Airlines engages in business aviation, e-commerce platform management, and ticket agency services. In terms of property management, the company offers a range of services, from leasing to investment and consultation. The airline is also involved in research and development, focusing on technology and products related to the aviation industry. Additionally, it provides an aviation advertising platform operation service and develops information systems and technical services. With a fleet of 804 aircraft as of December 31, 2024, China Eastern Airlines Corporation Limited has established itself as a major player in the civil aviation industry. China Eastern Airlines Corporation Limited maintains a market capitalization of $93 billion, broadly in line with the industry peer group. China Eastern Airlines Corporation Limited trades at a lower price-to-book ratio of 1.62 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company exhibits a very high leverage profile, with liabilities accounting for 85% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Liabilities have increased, while assets and equity have failed to keep pace or declined. This suggests the business is not growing and may be in decline, making it a highly unattractive investment from a risk perspective. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline can be identified through a thorough analysis of the provided data. On the revenue growth side, several key factors contributed to the increase in revenue. Firstly, traffic revenues from passenger and cargo operations saw significant growth, with passengers up 6.4% and cargo and mail up 2.7%. The airline transportation segment experienced a substantial increase of 50.3%, while other segments saw a notable rise of 455.6%. Domestic, regional, and international operations all contributed to the revenue growth, with domestic operations increasing by $1,257 million, regional operations by $198 million, and international operations by $7,880 million. Additionally, cooperation routes income and foreign exchange income were new revenue streams in 2025, adding RMB 221 million and RMB 205 million respectively. On the other hand, several factors contributed to the decline in revenue. Ticket cancellation and commission service saw a decline of 5.3%, while route subsidy income decreased by RMB 101 million minus 31.3% decline, and gain on disposal of items of property, plant and equipment. Right-of-use assets and intangible assets decreased by RMB 187 million minus 47.4% decline. Furthermore, passenger kilometers yield declined in both domestic and international routes, with a minus 5.03% drop in domestic routes and a minus 1.22% drop in international routes. Regional routes also experienced declines in revenue, with RFTK down by 6.49%, weight of freight carried down by 5.84%, and ATK down by 5.76%. Overall, the data suggests that revenue growth was driven primarily by increases in traffic revenues, airline transportation segment revenue, and international operations, while revenue decline was attributed to declines in ticket cancellation and commission service, route subsidy income, and passenger kilometers yield. The net income of the company experienced a significant change between 2024 and 2025. Initially, it increased by $956 million from $6,503 million to $7,459 million, indicating a substantial growth in profitability. However, this trend was also observed in the Chinese market, where the loss decreased from RMB 4,798 million to RMB 1,952 million. Furthermore, the net income showed an increase of 14.3% from RMB 6,503 million to RMB 7,459 million. The profit margins of the company also underwent a notable change during this period. The operating and net profit margins increased from 4.9% in 2024 to 5.3% in 2025. This improvement can be attributed to an increase in operating income by 139% and a decrease in finance costs by 51%. Additionally, the growth in cooperation routes income, gain on disposal of items, and other factors contributed to the enhancement of profit margins. The primary reason behind these changes was the significant increase in revenue and other operating income and gains. The total operating expenses only increased by $6,522 million, resulting in a substantial improvement in profitability. Moreover, international market growth played a crucial role in driving profit margins improvement, particularly due to the rise in passenger aircraft belly-hold revenue. The company's debt level has experienced significant changes over the past period. According to the extracted summaries, the total interest-bearing liabilities increased by 3.39% from RM 175,969 million to RM 181,928 million on page 30. However, a closer look at other pages reveals that the interest-bearing liabilities actually increased by 10.04% from RM B 73,067 million to RM B 80,400 million on page 31. On the other hand, the company's interest expenses have decreased significantly. The total interest expenses decreased by RMB 963 million as mentioned on multiple pages, 11, 14, 24, and 29. This represents an 18.71% year-on-year decrease in interest expenses. The performance of various segments and regions within the company has been analyzed. Unfortunately, there are no standout performers to report. However, it's worth noting that one segment, Other Services, showed a small income of RMB 125 million on page 10. On the other hand, several segments have underperformed. Airline transportation operations, in particular, have struggled. Despite an increase in revenue from RMB 139,548 million to RMB 131,802 million, the segment's loss before income tax has actually worsened, from RMB 772 million to 5563 million. The poor performance of airline transportation operations is a significant concern for the company. The reasons behind this decline are not explicitly stated in the provided summaries, but it's clear that this segment needs attention and improvement. Management is expressing a positive outlook for the company's financial stability. With sufficient financing to operate for at least 12 months, the company can focus on its growth strategy without immediate concerns about cash flow. To mitigate risks associated with international business, management plans to implement measures to minimize exchange rate fluctuations. In terms of debt management, the company aims to optimize its debt mix and issue short-term debentures to reduce interest rate volatility risks. This proactive approach demonstrates a commitment to prudent financial planning and risk mitigation. Furthermore, management is prioritizing information security, strengthening management capabilities, and improving data protection to safeguard against potential threats. As the company expands into new markets, it will enhance monitoring and management of external investments and implement robust risk management mechanisms. These strategic initiatives demonstrate a forward-thinking approach to growth and a commitment to responsible business practices. Overall, management statements convey confidence in the company's ability to navigate challenges and achieve its objectives. The company's financial activities have been focused on share buybacks rather than distributing profits to shareholders. According to the extracted summary, the company has indeed bought back shares, as mentioned on page 26 of the document. Furthermore, it is proposed that no profit distribution will be made for the year 2025. This decision will be subject to consideration at the annual general meeting in 2025, which implies that shareholders can expect no dividend payment for this particular year. There are concerns about inventory buildup or supply chain disruption in the company's operations. One area of concern is inventory buildup, particularly in aviation ancillary services and properties leasing and construction management agency services. The total value of right-of-use assets has significantly increased in these areas, indicating potential inventory buildup. In addition to inventory buildup, there are also concerns about supply chain disruption. For instance, the amount received from freight logistics business support services decreased by 143 units, suggesting a possible disruption in the supply chain. Furthermore, the amount paid for cargo terminal business support services increased, which may indicate inefficiencies or bottlenecks in the supply chain. Overall, these trends suggest that the company's operations are facing challenges related to inventory buildup and supply chain disruption. Addressing these concerns is crucial to maintaining efficient and effective operations. That concludes the financial summary for China Eastern Airlines Corporation Limited. Feel free to comment below, and I will be happy to answer them when possible.